Have you ever wondered if there's a simple, straightforward formula for finding really great investments? You know, the kind you can buy and hold for the long term without all the constant stress and noise of the market? It's the question that's on every smart investor's mind.
Well, you've come to the right place. Welcome to another video on investment basics. Today, we're diving into a powerful framework put together by Mr. Majid Butt, who brings a pretty unique perspective to the table. He's an accountant, a software programmer, and an investment researcher.
And in this video, we're going to break down his strategy piece by piece. You're going to discover a simple formula for high returns, how to really identify high-quality companies, the true power of dividends, and we're going to wrap it all up with a practical 5-point investment plan that you can start using right away. So definitely stick around for that.
All right, here's our game plan. We'll start with that core formula. Then we'll get into what high quality actually means. After that, we'll explore the power of dividends and their growth. And finally, we'll pull it all together with that 5-point plan. So let's dive right in. First up, the simple formula for success. This is the absolute core of the whole strategy. Everything else we talk about today is built on this foundation. And here it is. It almost looks too simple to be true, doesn't it? You take a high-quality company, add a high current dividend, and combine that with high growth of that dividend. The result? High total returns. Think of this as our master filter. Every single investment idea has to pass through these 3 gates. If it fails on any one of them, we just move on. No exceptions.
So let's break that down, starting with the very first piece of the puzzle, and honestly the most important one. What exactly makes a company high quality? What's the real difference between just a good business and a truly great investment?
Well, high quality really boils down to 3 key things. First, and this is the absolute bedrock, is superior financial strength. A business is a financial operation after all. Next, we look for proven staying power, a history of surviving and thriving. And finally, you need strong and creative management steering the ship.
Financial strength really starts with one thing: low debt. We want companies that can fund their own success without relying on massive loans. Think about it. When the economy slows down, and it always does, companies with huge debt payments are in serious trouble. Those interest payments have to be made no matter what, and that money comes at the expense of dividends and the research needed to grow. So a key number to watch is the debt-to-capitalization ratio. As a general rule, if that number is over 50%, it's a huge red flag. The lower the better.
Okay, another way to look at this is something called coverage. This is just a fancy way of asking, can the company actually afford its debt? We want to see that its cash flow is at least 3 times bigger than its interest payments. A 3-to-1 ratio is fantastic. It means for every dollar they owe in interest, they have $3 of cash coming in to cover it. That's a massive safety cushion that lets you sleep well at night, especially when things get tough.
Financial strength also means having plenty of cash flow. Cash is the engine that pays for everything, especially our dividend and the company's future growth. We measure this with the payout ratio. What we're looking for here is a dividend that's a small, manageable piece of the company's profits. A payout ratio under 60% is a great sign. It tells us 2 crucial things. 1, the dividend is safe and isn't at risk of being cut. And 2, there's a lot of money left over to reinvest in the business, which will fuel future dividend growth. Now, you might be thinking, wow, do I need to become an accountant to figure all this out? And the short answer is no. There's an amazing shortcut. We can just let the experts at rating agencies like Standard & Poor's and Value Line do the heavy lifting for us. For our purposes, we want to see an S&P credit rating of at least BBB+, but honestly, we really prefer companies in the A range. With Value Line, we're looking for a B+ or better. This is such a quick and reliable way to weed out the financially weak companies from the start.
But listen, high quality isn't just about the numbers. Any seasoned investor will tell you, when you buy a stock, you're not just buying a piece of a business. You are investing in the people who run it. You're betting on their skill, their honesty, and their vision for the future.
And this quote just says it all, doesn't it? Let's be really clear. The single most important part of management is integrity. If the leaders of a company have ever been caught playing games with the accounting or misleading investors, you cross them off the list immediately, and you never look back. There are thousands of other places to put your money.
So how do we judge management from the outside? Well, here are a few questions to ask. First, how do they act when things get tough? The best managers actually use recessions to get stronger and steal market share. Second, look at their acquisitions. Are they making smart, small purchases that fit right in? Or are they doing these massive, risky deals that almost never work out? Third, are they good at extending their brands into new areas? And finally, does the company have a powerful brand or a special niche that gives it an edge over the competition? All right, so we've nailed down what high quality means. Now let's move on to the second part of our formula, the power of the dividend. And we're going to focus specifically on getting a high current yield, because that's what gives our compounding machine a huge head start.
This classic turtle versus the rabbit story shows you why that starting yield is so critical. Imagine we have a growth rabbit stock. It has a tiny 1% yield, but it's growing that dividend at a blistering 20% a year. Sounds great, right? But then we have our SCBI turtle stock. It has a solid 4% starting yield, but it's only growing its dividend at 10% a year. Well, guess what? It would take that rabbit over 7 years just to start producing the same amount of income that our turtle was giving us from day one. That head start is everything.
So what exactly counts as a high yield? It's always relative. So here's a simple, powerful rule of thumb you can use in any market. Your minimum target for a starting dividend yield should be at least 1.5 times the average yield of the overall market, like the S&P 500. A really good goal is to aim for twice the market average. This makes sure you're always getting a really strong income stream right from the beginning.
Okay, so we've got a high-quality company and we've got a high starting yield. The last piece of our formula is making sure that dividend is going to grow consistently over time. This is the part that keeps our income stream growing year after year after year.
So what kind of growth are we looking for? Well, your number one enemy as an investor is inflation. So at an absolute bare minimum, your dividend growth has to beat the rate of inflation. If it doesn't, you're actually getting poorer. So let's call 4% a good minimum. But what we're really shooting for to get that compounding machine really humming is a growth rate around 10%. At that rate, your income from that one investment will double about every 7 years. That's powerful.
So how do we figure out what the future growth will be? Look, it's not about having a crystal ball. It's about being a good detective. There are 3 simple ways to do it. First, look at the past. For a stable, high-quality company, its 5-year dividend history is a fantastic clue. Second, let the pros help you out. Check the research from places like Value Line or S&P. And third, you can connect the dots yourself. If a company says they like to pay out 40% of their earnings, and you see that earnings are projected to grow by 10%, it's a pretty safe bet the dividend will grow by about 10% too.
Okay, we have covered a lot of ground. We've talked about quality, yield, and growth. Now let's bring it all together into that practical 5-point investment plan I promised you. This is the summary you can use to guide all of your decisions.
Here it is, your entire investment plan on one screen. Think of this as your final checklist before you ever make an investment. Let's walk through each point together. Okay, point number 1. It's a simple formula. High quality plus high current yield plus high growth of yield equals high total returns. This is your North Star. Every potential investment must pass this 3-part test. No compromises. If it doesn't tick all 3 boxes, you just walk away. It's that simple. Point number 2. High quality starts with high financial strength and the ability and willingness to pay a rising dividend. Remember, this is the foundation. It's non-negotiable. We're looking for low debt, that's a debt-to-capital ratio under 50%. We want great coverage, at least 3-to-1, and a safe payout ratio under 60%. Point number 3. High quality includes management's honesty and management's ability to face challenges such as tough conditions or acquisitions, as well as to expand their niche. The numbers on the page are not enough. You have to be confident that you're investing alongside honest, capable leaders who have proven they can navigate challenges and make smart decisions for the long haul. Point number 4. High current dividend yield is always relative, but twice the current market average is a reasonable goal. 150% of the average is the minimum. This is how you give your compounding machine a powerful kickstart. Use that simple rule of thumb. Always aim for at least 1.5 times the market's average yield. And finally, point number 5. High growth of yield. Income should rise at least as fast as inflation. The faster the better. Past may be prologue, but projected earnings growth must support projected dividend growth. Your income has to grow faster than inflation, period. And remember, that dividend growth doesn't come from magic. It comes from one place: growing company earnings. The earnings are the engine that drives everything. And that brings us to the end. I want to leave you with one final thought. A little challenge. As you go about your day, just look around you. Which companies are you already interacting with? The coffee you drink, the phone in your hand, the stores you shop at. Which of those great companies might already fit this powerful, simple formula? I bet the answer is right there in front of you.